hearing for Tuesday, August 4th, 2020. The first case on our agenda is RPC 34027-005, 2611 Richmond Highway. Mr. Sean Radin is going to present for the appellant. Mr. Radin, you can start with your 8 minutes.
Good morning. Thank you very much. Appreciate the opportunity to come in and talk to everybody on this rainy morning. So we're talking about 2611 Richmond Highway, also known as Airport Plaza Office Part 2. The main issue here is these folks have been struggling for years. I know we've been here before to talk about this property. The issue really is, a difficult time with vacancy. This building is in a difficult spot here at the end of the Crystal City office area here, just, like the most southern tip. And it's, it's a difficult building to reach, and they've had a hard time leasing up. And it's, been just difficult for these owners. NOI and income continues to be a problem. And that's also compounded with COVID-19. I know we're not really discussing that, so I'm going to kind of move away from that. But we did include some information here from the ownership regarding rent abatements and things of that nature. But we don't really need to even discuss that because, the issues here really with the income and with the vacancy here, it's been quite difficult for ownership. So what I put together on page 4 of my packet here is is essentially the last 2 years of income, 2018, 2019. I also have the assessor model here, and we have a discount for lease up. So what we've done is we tried to put a stabilized market analysis for you on the left-hand side. So the way we did it was we used 2650 for both the occupied space and the vacant space. It's actually 70% vacant as of 1/1/20. So again, very difficult year. As you can see in the actual 2019 column, right in the middle of my page 4, their NOI was negative last year. So again, it's going downward. The value is going down. We're trying to reflect as close to a market valuation as we could here on the left. So again, I used 2650 as the rent here for both the occupied and vacant. We have additional retail income here, which we kept the model from the county for the additional income. We have parking income as well, same as the county model. We came down with a potential gross income of $5,592,000. We used the 25% vacancy, which is the county model here. Again, 70% vacant, 71 essentially percent vacant. We came down using. We actually used similar to the actual expenses here at 925. This is indicative of the actual expense, and we came to an NOI of $2,405,879. Again, we're in the negative this year, but come to an NOI of $2,405,879. Now, there had been some discussion about cap rates and different things. When I received the BOE response memo from Rob Peralta, he mentioned a 7.34, and I'm actually, that's fine. I understand that the COVID-19 is really not an issue, and so I had added some 50 basis points to the cap rate. So if we use a 7.34 on my model here on page 4, and keeping the lease up deduction that I calculated, which was $8,167,000, the indicated value comes out to be $24,610,046. So that's $24,610,046, and that's using the cap rate suggested by Mr. Peralta in his memo, which is 7.34, up from the original 7.09. So, we had originally requested a value of $20,388,100 here for the board, and I'm suggesting that that may be too aggressive based on the cap rate that we used. So again, if we use the 7.34 and keeping all else the same, our indicated value is $24,610,046, and I'll leave it at that.
Okay, thank you, sir. Mr. Bailey?
Good morning, board. As I stated, I'll be representing this case for Rob Peralta. If you can, please go to page 3 of the BOE packet. You'll see the summary sheet there. Well, we have laid out the 3-year operating history, the original DREA assessment for 2020, the 2019 operating history that we received this year around March, the revised value that was presented to the agent and their client, and then the pro forma provided in the BOE appeal. This property, as you can see by the way Mr. Peralta has laid it out, has experienced some high vacancy over the years, but you can see that starting in 2017, that vacancy began to trickle down some. I think the agent even pointed out that the vacancy was 85%, then it dropped down to 79%, and in 2019 it was at 70%. So we see that some lease-up activity is going on in this property. The NOIs continue to show that it's negative. That's due to the high vacancy that they are reporting, and I mean that is expected also with such a high vacancy. But you can see that the negatives are decreasing as well, and eventually it'll turn to positive. Hopefully, with a lot of activity that's been going on in this area, with the move-in of Amazon, Metro opening new stations in this area, and with other institutions such as UVA and Virginia Tech announcing construction of new campuses in the near area, this property hopefully will change. But as far as the numbers are concerned, Mr. Peralta took a look at the rent roll that was provided with the I&E statement, and that is located on page 7 of the packet. He took the time to break down the tenants that are in place, the rents that they are paying, and he did a weighted average of these leases in place. As you can see on that page, there were 22,371 square feet of occupied space that he was able to calculate the rent rates for. There are 34,261 more square feet of space I believe he was unable to get any information for, and therefore did not include it in this calculation of his weighted average. And he also lists the spaces that are vacant along with the total vacant space of 136,704 square feet. Again, that is much less than the 153,000 that they reported last year. So this property is seeing some lease-up activity. Mr. Peralta increased the vacancy from the initial assessment and therefore increased his below-the-line deductions. The original assessment was $30,562,400, and his recommendation is $28,171,500. Some things that we wanted to point out: this property was appealed last year, as stated by the agent. The department did a review and reduced the assessment down to $29,802,500. Again, you can see that the revised value for 2020 is $28,171,500. Part of that is due to the addition of the bid rate to the cap rate, because this property does fall within the national landing bid, and this is the first year in which it has been assessed a bid rate. The department believes that due to the analysis that we did, The adjustments to the vacancy of the property, the revision should be confirmed by the board. Again, that's 28,171,500. And we are here for any questions that you have. I think one thing to also point out is just in regards to this property, again, we understand that it does have high vacancy, but it also is doing better than it's done in the past, and we take that into consideration. We don't believe that the improvements we're making, the improvements they're making are being blown out of proportion by our assessment. Some of the differences between, I guess, how we're viewing this property and how it was viewed last year is we're actually in line to just say that the assessment is flat, even though the lease up is an increase of 16,705 square feet. That's a difference from the agent who is actually showing a lower NOI than they did last year for this property, even though it's improving as far as lease up. One of the differences also is we have the property as essentially being flat from an assessment standpoint, whereas there's a difference of opinion by the agent of almost $9 million from last year to this year for this property type. And that's another reason why we believe that the assessment is more accurate and should be confirmed by the board. That is all.
Okay, thank you, gentlemen. Questions from board members? Mr. Hoffman.
Yeah, I guess for the appellant, it appears Mr. Bailey's talking about kind of improvements year over year, and it does appear like there's a leasing strategy in place. Is that the owner's approach right now, is to kind of lease up and improve the property and gradually decrease the vacancy? Is that the strategy?
For sure. I mean, obviously, vacant space is just hurting the property, but of course they want to lease it up as much as possible, and they have leased it. They have increased the occupied space for this year. You see in the NOI being negative. So what they're doing is they're giving away free rent. They are putting in a lot of concessions and things of this nature just to entice folks to lease up. And so that's one of the reasons why the NOI has continued to drop. So even though they did increase some leasing, for year end 19, the NOI had actually dropped from the prior year. So even though they've gotten some leasing, it hasn't really transferred to revenue quite yet. But I think perhaps next year is going to be a better year. But unfortunately, it was looking like it, but with COVID, I've included some documentation. We've got several $100,000 of revenue that is not going to be collected. So next year might not improve. We'll see.
Okay.
Okay, other questions from board members?
I have one for the department.
Mr. Penaranda?
Good morning, Mr. Bailey. I just wanted to clarify, was the assessment value reduced already, or is it, because I don't see that it's being reduced. So are you asking us to reduce it, or to, because I know you mentioned to confirm the revision, but it doesn't show that it was reduced already.
With these cases, we reduce it, but if there's a BOE appeal, then we can't really put it on the books because the owner has the right to come before the board, and then whatever the board decides goes on the book. So it'll be a reduction to our request. I think that's how we handled it. We weren't able to reduce it at department level before they filed a BOE. That's why we couldn't put it on the books. So I guess I have to work on how I phrase it when I say confirm our reduction. If anything, just like that's the reduction that we proposed, and
Okay.
we ask that the board take it up.
Okay, thank you.
No problem.
Mary, this is Ken. Can you see me?
You can go ahead, Mr. Metzger.
Can you see me?
Yes.
Yeah, okay, great. I have two questions. First, for the appellant, you had made mention that the $9.25 a square foot is an actual expense. In 2019, reported $6.25, I believe it is. So is the actual for year-to-date 2020 or what?
I had that number as 925 being the actual expenses. So it may be a mistake in the spreadsheet perhaps, but that was the number that I had in here in my analysis.
But for what period?
That was year end 19. And
It's 630. Yeah.
okay, 1 second here. That may be that may have been incorrect. That might have been a spreadsheet mistake there. So
Okay, fair enough. For the department, a question. You assign on line 3. Let me look across. Retail office. Yeah. Okay. Oh no. Okay, no, I got it. I looked across incorrectly. I have no question for the department. Thank you.
Okay, Mr. Hoffman?
Yeah, I was looking on CoStar at this property, and there's a bunch of pictures of a really nice, it looks like a recent build out, and it's titled Excel Space. And I'm not sure, maybe that's since January 1, but I don't see an Excel Space lease, or I don't see any. How is that space reflected on the income and expense reports? Is there income for that space, or is it just a spec build out that's empty?
I have to say that I'm not familiar with that space. That may have been something that came after 2020. Is that like a co-working? What is that? Excel? Is that some type of building amenity, perhaps?
Yeah. So if I go on CoStar, it's called Excel Space, and then if I search for Excel Space, it says office space for entrepreneurs, growth ventures, etc. So I think it's kind of like a WeWork type concept, but it doesn't look like you have a lease with Excel Space or with an operator. So would that be
That must
income
be
that just is that other income? I mean, somebody wants to use that space. How do they pay the property owner?
I think that may be a new building amenity, and I haven't, and I can't really speak to how that amenity works. I don't know if Excel is a company that is leasing out like a WeWork, or is it something that the building put together as, like a an amenity for folks that are leasing space that might need like additional conference room or some additional.
Greg, does it say that it's a sublease space or prime in CoStar?
This is if you go to the property website through Conterra Realty and you click on search properties and you go to 2611 South Clark. That's this building, right? And then you just look at the photos and there's a bunch of really nice build out. It's like very modern, and it's called Excel Space.
Hard to know.
So I mean, the point of my question is in the appellant's pro forma for 2020, are you figuring any income from that space?
No, the model is based on just purely 2650 rent for occupied and vacant. The additional income is based off of the department's model, and that's really not factored into it. We have parking, some other income that we try to keep the same as the department model, but no, that's not included. But what is included is the actual income that has the negative NOI for 2019.
Okay, any final questions from board members? No, then Mr. Bailey, if you take a minute to wrap up, please.
As we stated in our opening remarks, we see that the property is making some improvements and is reducing its vacancy. It has a decrease about 15% over the last 3 years. The test column, or the revised column actually, is the number that we're suggesting to the board. That value is $28,171,500. Again, you can see not only in the vacancy shown that the property is doing better, but also in the NOI. The NOI is reported negative, but from 18 to 19, there has been significant improvements in the NOI and is expected to be above zero within the coming years. So based off the information, the testing that Mr. Peralta did, we asked that the board take the value that we recommend. That's all. Thank you.
Okay, thank you. Mr. Radin, if you take a minute to wrap up, please.
Yes, thank you. Again, while the leasing has increased a bit, revenue hasn't really come around yet. Try to show here on the difficult position the building's in. Our model, again, which I'm adjusting now, utilizing the department's cap rate of 7.34, indicates a value of $26,610,046. It's about $4 million difference from the department's recommendation. So we ask that you consider the performance here of the property, and thank you.
Okay, thank you, sir. Okay, it's just among board members. What does everybody think? Mr. Hoffman?
I think we looked at this case last year. We did a slight reduction to around $150 or $160 a square foot, and there's the department's recommending a modest improvement this year. Looks like there's been some pretty serious investment and improvements in the building, and none of it's reflected on as far as future income in the pro forma right now. So I would support a modest increase in the assessment that the department's recommending.
Okay.
I don't think this property is quite in the tailspin that the appellant is making it out to be. Otherwise, they wouldn't be investing in the interiors and putting. I mean, from these pictures, they put $100 a square foot into this Excel space easily. And I just doing some more searching. It looks like it opened in November with a grand opening ceremony. So maybe it's a related company and they don't have a lease, but there's something that's being held back here as far as income potential from it.
Okay, thank you. Mr. Matzkin.
On that, my original question was, what would be the objective criteria you'd use to increase it? And is it increasing from the 30 million or the 28 million? But as this is for Greg, for all of us, but based on what Greg said, but it seems that the potential may be there. The landlord's doing the right thing, but as of 1/1/20, hasn't the landlord or the owner, building owner, hadn't realized the hopeful gain in any significant way. And maybe this 2020 is the pivotal year with Amazon coming in and with hopefully the investment paying off over time. And so I thought that getting into the potential based on what they've done is not the prime criteria, but rather what is the actual situation there on 1/1? And the answer is it's pretty bleak. And so the below the line vacancy and TI and investments and brokers' commissions seems to make sense for this year. But it's the third year in a row where things are not at all productive in this building. And so the other reason to look for 2021, and if and when this building owner comes back, is to see what the situation is, because 4 years is a real good trend, and have to start making real adjustments above the line if things do not improve significantly. Going from, what Mr. Bailey said, from 80 to 70% or so over the last year, vacancy is an improvement, of course, but it's still really ugly.
Okay, thank you. Other board members?
I'll go with it. Yeah, I thought the expenses was one of the main factors, but looking at what they have already reported, which I don't think it's a typo. I think it's the amount of 635 is correct, based on the full amount and the square footage. But I think the numbers that the department is using on the revised assessment, $27 square foot, and the vacancy and the deductions, I think I'm fine with that. And this is actually a reduction from last year, so I'm okay with it.
All right, any other opinion contrary to what's been said? Okay, would somebody like to make a motion?
I'll go ahead and move that we make a reduction in this assessment to 28,171,500 based on the revised assessment.
Second.
Okay, motion and a second by Mr. Matzkin. All in favor?
Aye.
Aye.
Opposed? Okay, it's unanimous. The assessment is reduced to the county's revised number of 28,171,500.
Thank you, board members.
Okay, thank you, Mr. Bailey. Okay, we're gonna go back on the agenda to the first case. RPC 150240007 at 1723 North Wayne Street. And we have Mr. Eric Minkov speaking on behalf of his property. So you can start with your 8 minutes and tell us about your property, sir.
Good morning, and apologies for the technical difficulties earlier.
No problem.
We'll strive to make efficient use of everybody's time here. We're certainly not going to need 8 minutes. We attempted to lay out our conclusion from our appeal using a transparent analysis that was tied directly to objective data. And the appeal was rejected with some qualitative assertions. One was that the comparable locations we chose have larger lots, and therefore they'll always result in lower per square foot values. And the second was the improvements of the comparables aren't equivalent. While we believe we adjusted for the improvements in our analysis, we'll concede the point and accept the county's proposal on the improved value. And so that leaves the matter of the land value. One of the comparables we used was materially larger. The remaining ones are all quite similar. So if we exclude the much larger land and we utilize the remaining ones, the implied value of the land is including the improved value assigned by the county, is a fair value of $1,629,508. And as it turns out, all of the comparables utilized by the county were smaller, with one exception, which was quite similar in size. And if we utilize that one, the implied fair value of the house with the land and accepting the county's improvement is extremely similar to the analysis using our comparables, $1,639,405. So we believe that the range 1.63 to 1.64 million reflects a reasonable conclusion, incorporating the data we identified and that the county identified. We acknowledge reaching these determinations is complex. Any set of locations can suggest somewhat different results, And so we've attempted to avoid quibbling at the margin. We're relying on data and incorporating meaningful elements of the county's perspective. And we believe that the data demonstrates a value of about $1.64 million represents a fair assessment of the value of the property at hand. Thank you for your time.
Okay, thank you, sir. Mr. Dubai?
Yes, good morning, board. My name is Derek Dubay. I'm a residential supervisor, and I went and viewed the property in June of this year. I did an interior and exterior inspection. I did receive the information submitted by Mr. and Mrs. Minkov on the case, and I was able to review that. The subject property is a two-story, 2,700 square foot house built in 2003 with an EA of 2003, and the quality is excellent. So I went and looked at the comparables that they were reviewing, and I looked at comparable sales in the recent analysis period, and I felt that the sales that they were reviewing and breaking down a price per square foot had older qualities and larger land values. And anytime you look at a property that has a larger lot size and break it down a per square value, it gives you a smaller per square foot valuation. But the way that we do our values is on a per home site basis. And the home site value in this neighborhood is $950,000 for all of the lots in the neighborhood, and we go up or down depending on the size of the lot itself. So we don't do it on a per square foot basis. Excuse me. But in reviewing the comparables that we provided and the value that they're asking for, which was $1,550,000, you can see that older, smaller properties are selling for that value. So we felt that our assessment was in line, and there wasn't any reason to make a change for this year. Thank you.
Okay, thank you. Questions from board members? Mr. Hoffman, I'm sorry.
For Derek, the lot value, the base lot value is $950 for the neighborhood, and the subject property is $959,500. So what was the $9,500 adjustment?
So these are our 6 lots. They're 6,000 square foot is the average, and this one's slightly over the 6,000, and it's receiving a 1% size adjustment over the average.
Okay.
Yeah.
All right, thanks.
Other questions from board members?
Mary Barnes, I have one.
You certainly can, Mr. Lawson.
Okay, thank you. For the applicant, what's behind your lot?
We are abutted partially by a neighbor's house, and then so sort of to the side and back is a neighbor's house. Otherwise, there is a narrow strip that I guess people use to drive in and park, separating us from backyards that face, I think, North Beach.
And Mr. Lawson, there is a plat map in the package too that shows that for you.
I think it's an alley, Barnes.
Right. I was wondering if that was being utilized. And do any of the lots have garages facing the alleyway, or is it too small?
Yeah, the subject
That's
has
for me. Yes, we do.
Yeah.
Okay. Any other questions from board members?
No.
No? Okay. All right, Mr. Dubay, if you take a minute to wrap up, please.
Sure. In reviewing the case, the subject property increased 3.9% for this year, and the average neighborhood increase was 5.3%. So they're below that average, and also the county average was 4.3%. So I felt like their increase for this year was in line. It was actually all on the land, which was applied to everybody's lot in the neighborhood on that base rate. And in reviewing comparable sales and comparables provided, I felt like their current assessment was in line. And that's all. Thank you.
Okay, thank you. Mr. Minkov, if you take a minute to wrap up, please.
Sure. When we utilize the comparables that we identified, excluding the ones the county suggests we exclude, and when we utilize the comparables that the county identified that don't fall victim to the flaw that the county identified in critiquing our comparables, we end up with a very tight valuation using the most current data, which is $1.63 to $1.64 million for the house. And we believe that there's a internal equity standard of utilizing data to reach these sort of conclusions.
Okay, thank you, sir. Okay, it's just among board members. Mr. Hoffman?
I mean, there's definitely some value in having a larger lot. The county put 9,500 on it, which I think is pretty consistent practice. This neighborhood, there's a lot of 6,000 square foot lots. So I'd be really concerned about trying to get out of that 950,000 range, just throwing off everything in terms of equalization. You know, if the appellant brought forward a case that said that there was something unusual about the lot, or you couldn't build a house on it because there's a, you know, RPA, or there's some, you know, some issue with the lot, but it seems to be in line. In fact, as Barnes is alluding to, I think the alley could ultimately be an additional value to the house. You know, if they ever decided to put a garage or something back there, they would have another access point. So I'm fine with the county's assessment.
Greg, a lot of the lots around it are the same, you know, 959. I mean, it's not unusual.
Okay, Mr. Lawson?
Yes, we represent a lot of the single family house builders. And one of our clients is very active in this neighborhood. And what they look for is, you know, the shape of the lot, the width of the lot, whether it's a corner lot, and topography. And looking at this lot, it's about as good as you're going to get. And it's got plenty of width. It's got it's not a corner lot. Doesn't really have a double frontage because of the alley. And we've been finding lots going in this part of Lion Village, or in Lion Village, right at about 950. We've even seen some higher. And this is the one industry that does not seem so far, knock on wood, to be impacted by the virus. When you look at a lot, you know, the builders look at it as a building lot, not a large lot. And there may be a very minor increase in value for a really large lot, but the value is derived from the fact that it's a building lot. So I myself am okay with the where the county is on this.
Okay. Any other comments, Mr. Penaranda?
Yeah, I mean, I think the county's assessment is pretty fair compared to everything else that, you know, is in the neighborhood and the area. Other homes have been assessed pretty much the same. Even looking at all the online valuation methods that are available, you know, Zillow, Trulia, Realty Track, and everything else, all of them are much higher than this assessment, you know, ranging from 1.79 to 2,000,004. But, you know, normally we don't even consider that, but that just shows that the value is there. And just to clarify also, Greg, that this property does have a garage, I mean, a double garage in the back. So, yeah, it is a good value to have the alley in the back. I'm okay with the assessment.
Okay. All right, would somebody like to make a motion then?
I'll go ahead and move that we confirm the assessment at 1,701,300.
I'll second.
Okay, motion and second by Mr. Yates. All in favor?
Aye.
Aye.
All right.
Opposed? Okay, it's unanimous. The county's confirmed at 1,701,300. Thank you, Mr. Minko. Okay, moving back to case 3 on the agenda. Mr. Radin, is your camera on?
No, it's not. Sorry. It's disabled for security reasons. Not for the board, but just in general.
Okay. RPC 1802420, 1025 North Fillmore Street. Mr. Radin.
Yep.
Madam Chairman, I have a disclosure I'd like to make.
Okay.
This is Zozo, right?
Yes.
sir.
Yeah. One of my best friends and clients is a tenant here. They own the Green Pig Bistro restaurant. And before his son was running it, but I think given the current situation, Scott Harlan has now become really involved. And I don't think this will not impact my ability to fairly evaluate the value of this property, but I do want to disclose that there would be an indirect impact on a client and friend.
Okay, is there any objection, Mr. Radin?
No, ma'am.
Okay, and Mr. Chikas, any objection from the county?
No, I think that's fine.
Okay, all right, thank you. You can proceed, Mr. Radin, with your 8 minutes. Tell us about the property.
Thank you so much. So, Zozo Flats, it's a mid-rise retail and apartment building in the Clarendon/Courthouse submarket, built in 2007. You know, it's got an apartment aspect, and we're not really we're okay with the valuation methodology for the apartment portion. We're really discussing here the retail portion. Now, I included a lot of information regarding COVID-19 again, because we weren't sure how it would be considered in this year. As you can see, they are receiving quite a few requests for abatement and such for 2020. And I've included some emails and some documentation from the ownership here. But again, I understand that that's not really an issue for this year. And so just looking at the actual data, I think we can still see that the actual income it is below what the county model. And so I'm on page 7 of my original paperwork submitted, and I don't know the page number of the major packet that the county put through, but it's on my page 7, the green sheet, which has the income here for the last 3 years against the assessor's income. And as you can see, the NOI has continued to decrease, and you can see that it's been below the county model for the last several years. So what we did here is we built a stabilized model here on the left-hand side, which we use $35.50, similar to what the county has here. We have the pass-throughs or other income here of $217,457. Our potential gross income, 3% vacancy, and our expense percentage is, as you can see, it's about 16%, slightly above what the county has. We did increase the cap rate again for COVID-related issues that we've demonstrated here are affecting the property. However, if you use our originally in our department a 7 cap, similar to the county, our indicated value then becomes $9,935,711. So that really is our requested value. At this point, it's $9,935,711. That's with our stabilized model using the assessor county cap rate of 7%, and that's our valuation there based on the performance of the subject being slightly below the county model, and utilizing that model with the county cap rate of a 7 cap equals 9.9 million valuation. Thank you.
Okay, thank you. Mr. Chikas.
Good morning, board members. Good morning, Mr. Radin. Speaking of Zozo Flats, as indicated by the appellant, it is in fact a mixed-use multifamily. When looking at metrics, we noted that apartment revenue is up 1.3%. In 2019, retail revenue also up, but up 3.3% in 2019. Pass-through revenues was up 2.3%. Parking revenue was up 5.3%. And utility reimbursement, or RUBS, was up essentially 100% in 2019. Gross potential income is up 1.6%. True vacancy was up about 0.3%. It's essentially stabilized at approximately 4.5%, 4.7%. The effective gross has been up now 2 years in a row. 2019's increase was 1.4%. We did note the operating expenses did tick up, but again, at 0.6%, so 0.6% in 2019. The 3-year operating expense as a percentage of effective gross had an average of 20.36%. Note the county's at 20.38%. Net operating income has increased 2 years in a row. 2019's increase was at 1.6%. As we look at the projections made by the county before we received the 2019 income and expense information, I'll point out that the county underprojected gross potential income by approximately $18,900. We underprojected effective gross by $35,800. We underprojected operating expenses by $15,600, and that led to an underprojection of NOI by approximately $20,200. So the property is increasing in value year over year, and we underprojected that growth. Would want to point out, as we have previously, Virginia Code 58.1.3295.1 empowers the board to consider the actuals that are achieved at the property, but to be clear, that only empowers you to consider that on the multifamily side and not the retail side. But even if you were to make an adjustment to the retail, we would ask you to consider the underprojections on the apartment side as well. Given that we underprojected across the board, but importantly on the net operating income side, and that again, the operating income at the property has increased year over year, we do believe the county should be confirmed at $71,029,000. Thank you.
Okay, thank you, gentlemen. Okay, questions from board members? No? All right. Oh, Mr. Metzgen.
2 questions for the appellant. The first one is, and I was going to ask this in the last case, but it's still relevant. You, of course, discussed this case with department personnel before you came here today, right? Mr. Ray?
Yes, thank you. We've discussed the matter via email and things of this nature. I don't know if we've actually had actual conversations per se on this property. This was really.
But you had interchange. My question was, did not the effect or non-effect of COVID virus come up in any of your interchange the last couple of months?
No, we didn't know how necessarily how the county was considering it, and then once we heard from the ownership of the building about the requests and troubles they were having in early 2020, you know, we wanted to present that information to the board. We did not know if that was going to be considered.
So the question was never asked, so it was never answered. Okay, that's too bad. The other question is, why do you project a decrease in retail income for, you know, your current?
Yeah, we used the actual income that we were provided, and that indicated a decrease in the year-over-year performance. And the information here is what I charted for you. Our information shows a decrease.
A real decrease. Okay, thank you.
Okay, no other questions? Okay, Mr. Chikas, if you take a minute to wrap up, please.
Yes, ma'am. So given the year-over-year operating performance increasing, we do believe that the underprojections made by the county would call for a confirmation of the county's value of $71,029,000. Thank you.
Okay, thank you. Mr. Radin, if you take a minute to wrap up, please.
Thank you. And, you know, opposite what Mr. Chikas has stated, we believe the performance of the retail portion here has shown that it's not as strong, and we've been able to show that the income has actually decreased based on the information that we put forward here, and it is our belief that the assessment should thereby correspond with their performance, indicating a value of about 9,935,711, and that is our request. Thank you.
Okay, thank you, gentlemen. It's just among the board members now. What's everybody think? Mr. Hoffman?
I mean, I just doing a 3-year average, 17, 18, and 19, I came up with 756,000 net income for the retail property. At a 7 cap is 10,800,000. So it's a little bit lower than what the county had for retail, but I think that's, I don't know. I didn't want to go back 4 years because that's a little bit long. We usually just see the 3 years prior. So that's how I looked at it, rather than try to guess at next year.
Okay. Mr. Metzgen?
I see, this all looked consistent to me and appropriate. I even noticed that the department estimated a decrease in the rental retail income. But I also noticed a unwarranted, small but still telling decrease in the department's work on operating expenses. It pretty consistent, high one. This is retail only, of course. A high 135, 136, 137, but yet in the department's work for this year it's 115. And I didn't notice that during our Q&A session, but I suggest that it's pretty clear that that ought to go up $20,000 based on history. So I can run the numbers certainly, if anybody is interested.
Right, and I don't certainly want to speak for the county, but I believe that Mr. Chicas did say that they underestimated the operating expenses. I'm assuming that had they done a further test, that it would have increased.
But that they underestimated some incomes, and I'm also assuming based on history, the county would say one offsets the other. Good point.
Yeah, I don't feel as compelled on this as I have in other cases. It is slightly higher on the retail, but I'm guessing if you did an average on the other for total income, the apartments might be slightly high. I don't know. I don't feel a need to make an adjustment, but open to hear anybody else. Mr. Penneron?
Well, I thought if any adjustment would need to be made would be on the expenses on the retail. But yeah, I think it would be minor. But the only thing I did is I increased it to 15% instead of 13%, which comes to 133,141 on expenses, which is a little bit closer to what their actuals are. That brings the retail to 10,778,100. Again, looking at the overall value and also in the apartment income, I have to agree with Mr. Chicas. I think the assessment overall is fair.
Okay. Any other?
No, expenses are slightly off, but I don't see anything for a real adjustment.
Okay, Mr. Lawson?
I guess if you, when you file an appeal, I don't think you can say, my appeal is only on commercial. Or if it's a single family house, my appeal is only on the improvements. I mean, once you open it, don't you open it to everything?
Yes.
And given that, I'm okay with where the county is.
Yeah. Mr. Huff?
Yeah, I'm okay with the county too, and I think going through the rent roll, these are all triple net leases, so whatever the expenses are, the tenants are paying for them. So it's really, it's kind of irrelevant in my book.
Okay, any other?
Greg,
Alright.
it's relevant to the tenants.
That's
All right,
true.
then I'm going to move to confirm the county at 71,029.
I'll second.
Okay, second by Mary Hogan, all in favor?
Aye.
Aye.
Opposed? Okay, it's unanimous. County's confirmed 71,029 even.
Thank you, board members, and have a pleasant day.
Thank you,
Thank
board
you.
members. Thank you, Mr. Hayden.
You too.
Okay, we just have one more case. Do we need to take a 5-minute break for folks?
I'm fine.
No?
We
Okay.
can go.
Alrighty, then we will move on to the final case, which is an economic unit 1800105G at 2042 16th Street North. Ms. Sporman, you can start with your 8 minutes and tell us about your property.
Thank you. Good morning. I'm just confirming you can hear me.
Yes.
Great, thank you. So this property is right across from the county office building. It is where Summers Restaurant is. There's a very old office building there. The board has heard this case over the last 3 years. It has been, or the last at least 2 years. Last year, the case was reduced by adopting the county's income, but increasing vacancy to 10%. This property is assessed as a commercial property, which is somewhat unfair in as much as over half of the space is an independent office building with, and it's on a number of different parcels. So the county's guidelines indicate a vacancy rate, or their assessment used a vacancy rate of 4% on this property when you look at the total potential rental income. The appellant used in their pro forma a vacancy rate of 15%. The history at the property is in 2016, the vacancy was 19%, 2017, 19.5%, 2018, 22%, and 2019, almost 34%. And that's all set forth in the bottom line of sort of blocked out space on page 27 of 161, which is our board appeal. The income at the property, the weighted average rent on existing office is $25.51. We used 27 on the vacant, which is the rental rate the county used. The weighted average rent on the leased retail is $9 a square foot. And we used 35 on the vacant retail, which is what the county used. And then there's storage space of about 2,000 square feet, and we used $11 per square foot, similar to the county. So the big difference in potential income in terms of the total gross potential is in the rental rate for the occupied retail and the occupied office. The pass-through income we've shown is 19,000. The county used 11. One of the items that you'll see is that's very different from the county is other income, and that's 51,748, and that includes some license fees. And those license fees are paid by the gym that's at the property. So the county did ask for leasing information on that space. It was not provided because it is a license agreement and it is not a typical lease, but the income for the space is in fact included in the stabilized potential column as well as the 2019 column. As I said, we used a 15% vacancy rate, and that compares to the 10% vacancy rate, which was adopted by the board last year. Operating expenses, the buildings are old. It's like a 1935, 1940 building, and the office, and expenses are high. The owners really aren't doing a lot to improve this property because it is a redevelopment site. They are leasing it on a month-to-month basis at present time. They don't have they don't have any plans to develop it currently, at least as of the first of the year. From what I understand, that would only change, it would only push off, current activities would only push off any plans to redevelop that space at this point. Because the property was assessed as general commercial, the county used a 7% cap rate. That's another area that I think is somewhat, it's somewhat unfair to the record owner, because if this was assessed as an office property, the cap rate would be 8.25% for half of the building. And if it was assessed, so that's certainly, you know, somewhat unfair to the owner to use a 7.7% cap rate when over half of the property is a separate and indistinct office building. The cap rate last year was a 7.25. We find no justification for reducing that cap rate. The other thing that happens here, when you look at a property that is assessed as the mixed commercial, that is also unfair to this asset, is that there's no discount for lease up on vacant office space. So that would seem to be wrong as well. Taking all those factors into consideration and using on the deductions page, which is set out on our appeal on page, I think it's 28 of your package, you know, we use 1 year lost rent, 2738 on the rent, and build out and 6%. Now, when you do that, you end up at a value that says, hey, yeah, this site should be redeveloped. But at this point, it's operating as an office building. There are no plans in place to redevelop it. Just like the county assesses property that is approved for redevelopment at that rate as it existed on January 1, this property did not have that potential on January 1. And so for uniformity's sake, it needs to be assessed using the income approach to value. Now, using an actual income approach to value that projects what could happen at this property, you end up at a value that is below the land value for the asset. So the land value here is, or $2,250,000. The land value here is it's not shown on Ms. Roskin's page, who has spent time with me to work through this case, and I appreciate and thank her for that. So our appeal amount is actually the land value. You could say, okay, so it should be the land value plus the income. That would be fine. Again, last year, the board adopted the county's methodology and increased vacancy to 10% to reflect vacancy at the property, and probably somewhat to account for the office. I mean, if this was an office building only and assessed only as an office building, the vacancy rate on that portion would be 25%. So by slotting it into this commercial category, the owner is being treated in a manner that is not uniform and is being penalized. The rents used by the county are too high, and the operating expenses slightly too low. The vacancy rate is incredibly low. And I'll just point out on the county's summary sheet, it shows that we used a vacancy rate of 13%, and it just shows one gross income figure, gross potential income figure. The actual gross potential income as reported on our appeal is very different, and our 15% is only taken off of the rents. So it is truly a 15% figure. Is that a beep for me, my time?
Yes.
Yes.
Okay, thank you very much. I've said everything I have to say.
Okay, thank you. Ms. Roskin?
Thank you, board. Thank you, Eileen, for being present today. This property, once again, we're looking at this property as of January 1, 2020. And we are looking at this and we are in the understanding that it is looking to be redeveloped. Exactly how it's going to be redeveloped is still questionable. However, when we look at this property, we're going, okay, so the management has made a decision to let the tenants, their leases to lapse, if you will, or go into a month-to-month basis, so that when it comes time to redevelop, it's easy for, you know, the tenants to vacate. So, but we're still in this this transitional phase, and so we're looking at this property. What are rents in this area? And so, first of all, we're treating this as a property class code 219, which is mixed office commercial. And so I took a look at our analysis and found a couple of properties that are all within 3 blocks of metro stations, Clarendon Metro and the subject's courthouse metro station. And when I looked at those, the properties had an average rent of $49, $47, and $44 a square foot. And when we're assessing this property, we use something less than that, definitely less than that. We also went further and we took a look at the office, what is office rent going for in this area. And once again, we use something less for the subject than what is being achieved in this market at $28 to $29 a square foot. And we did the same thing with the retail. And in this, the subject's neighborhood, we're getting retail in the area of about $43 to $45 a square foot. And if you look at the original assessment, we're definitely using something less than. And so when we assess this property, obviously we don't get, for general commercial, we don't use below the line adjustments. So what we can do is we can lower the rent that is used. And in the original assessment, the 2020 assessment, that's what we did do. And yes, we do recognize that there is a high % vacancy with this property, but that is a management decision, as they're slowly getting rid of tenants for redevelopment. And although I know that one of the tenants has a licensing agreement, however, several of the tenants, if you look on page 3, just so I don't disclose any information over the internet, look on page 3 and you go down to where it says DREA test. And I'll read out the first sentence, but it's the second sentence I want you to focus on. DREA has noted majority of the leases are changing from long to short terms and or month to month. And then the next sentence, I'll let you read that. And I don't want to disclose it over the over this broadcast. So basically, yes, we did take into account, to recap, we did take into account the high vacancy, and we did that by lowering the rents for both the office and the retail. And we're just asking that the board accept the original assessment. And I'm finished. Thank you.
All right. Thank you, ladies. Questions from board members? Mr. Matzkin.
I have a question for the appellant. You mentioned twice that the department is assigning a 10% vacancy rate, and on the I&E summary, it's 4%. So you're giving them more credit than they appear to have warranted.
Thank you, Mr. Matzkin. Actually, what has happened in the past, this case was appealed last year, and the County Board of Equalization adjusted the vacancy rate upwards to 10% at this property.
Okay, great. So
the county, the vacancy rate you referenced for the county is correct. I was just referring to what has historically happened at the board.
Thanks. Can I follow up on that same
Yes.
tenor with the department? You mentioned, and it's well known, that a lot of the vacancy is due to management decision. Is that why you've, in anticipation sometime of, of redevelopment, therefore the department keeps the vacancy rate at the, I've forgotten this, the standard that you have for these kinds of buildings, 4%, and didn't go upwards to the 10 that was changed last year because it's a management decision?
Okay, so keep in mind the vacancy rate we're using is a stabilized vacancy rate for all of the 219 property class.
Right.
Okay, and then a way to account for the higher vacancy, because we don't do below, excuse me, we don't do below the line adjustment. We can go back to the top and look at the rents, and we lower the rents. So that's how we account for the excess vacancy.
I'll save it. Thank you.
Mr. Matzkin, or Madam Chairwoman, may I follow up on that for just a moment?
You can in your wrap up. Are there other questions from board members? Mr. Hoffman.
I'm not going to ask you where you are, Ms. Borman, but it looks really nice. Basically the whole block is owned by the same owner, except there's one building that's owned by the county. Is that correct?
That's correct.
So are they actively blocking the development by being in that one building that's kind of in the way, or is there any history on that you could share with us? Because other than that one little spike strip, it seems like this is a pretty cut and dry, redevelopment site.
I think maybe the county should address that portion since it's the county's property.
Does the real estate department have any history or background? And if not, then I'll let Barnes probably chime in with the history on this one.
Hold on just a second.
We don't have any information on that.
RPC 1800003.
We don't have any information on that as far as the situation between zoning or CPHD and the owner at this time. We could probably provide that at a later date, but at this moment, we don't have any information on it. We just know that there was plans to redevelop this site. Those plans were halted, and everything that's going on with the property is accurate to our knowledge based on what Ms. Roskin has discovered through her site inspection, as well as looking over the information that we have.
Okay.
Okay, any final questions? Okay, Ms. Roskin, if you take a minute to wrap up, please.
Thank you. Once again, I just want to reiterate that the market rents in this neighborhood are rent between $44 and $49 a square foot. That's combined retail and office. When you look at the subject on our original assessment, we're using something less than that, substantially less than that. And although we are using a 4% vacancy, stabilized vacancy rate, we did adjust some of those rents to accommodate the higher vacancy for the subject property. And we just ask that you confirm the original assessment at $7,571,400. Thank you.
Okay, thank you. Ms. Borman, if you take a minute to wrap up, please.
Rents at the property that have been generated both in the short term and historically have been very low. If you recall, this property is across the street. It's the kind of place that might have Belinda's or Bob's bail bonds in the spice, or divorces offered on site kind of thing. It's a terrible office building. It's very old. It's very cut up. It's very small tenant. It has is not comparable to other properties in the market. The county made a big deal about using rents that are lower, but in fact, the rents that are being generated at the property are significantly lower than the amount the county used and have been. This property was a planned to be redeveloped. It was determined it was not financially feasible. It is on hold for the time being. And there are no plans in the immediate future to redevelop this site. Although that could change. The vacancy rate used by the county is, they use 5% on restaurants. We have Summers Restaurant here. They used a lower rate. They use 5% on small office. We have a 15,000 square foot office here. They used a lower rate. Vacancy rate is higher, and we think that the cap rate is too low given the type of property that it is, and that the vacancy rate is clearly too low. Thank you.
Okay, thank you both. Okay, it's just among the board. What's everybody think? Mr. Lawson.
Thank you, Madam Chairman. I spent a whole lot of time on this yesterday, and here's my understanding of what's going on with this block. The county owns the little road that goes through, and of course the county would always be a seller, and you just need to use a formula and buy it for what the county wants. My understanding is that the site didn't lay out very well, and they wanted to acquire the CVS parcel, and the person who owns the CVS parcel drives a hard bargain. And so they've been attempting to consolidate. And, we've had a philosophical discussion about sites like this. Another one was the Staples over on Wilson, between Boston and Clarence. And when a landlord lets a property go because they know they're going to develop, at what time, when do you abandon looking at it as income producing? And so what I did was looked at it from the viewpoint of what's the land worth. And if you develop this, it's currently zoned C3. And C3 is just not a good by right category. And this will definitely be zoned CO. And you're in the courthouse plan, which gives you a bonus. And so just tinkering with what density would this property yield? I came up with about 27,000 square feet of commercial and about 103 residential units. And that could be, I could be off. It depends upon design, depends upon a whole lot of things. So then when you start looking at, well, what is raw ground, unzoned raw ground worth out there in the marketplace? And I think it depends upon, what do you need to pay the county for their land? And if in fact you need to acquire the CVS, what do you pay for that? What's the cost of development? So I think you're anywhere between 5 million to 11 million in value. And of course it's speculative. And so we can only go so far, but when you look at it, when the landlord purposefully allows the property to go, and this is a owner that can hang in there for years, I think you've got to abandon the cost approach or the income approach, because it's not being done in the normal course of business, because they're letting it go, waiting for the redevelopment opportunity. So, with a whole lot of talking on my part, kind of coming at it from a different direction, I think we're okay. I personally am okay where the county is.
All righty. Other comments?
Barnes, that it is the owner's choice of what they're doing, and
Correct.
And the county has gone close to a lot of with the guidelines, which is not what is actually taking place on the property. Most really it isn't, I guess. But the county's doing it the best they can at this property. They're not projecting the future.
Yeah, our obligation though is fair market value, and the county is using the income approach. I look at it more from the what is the land worth when you sell it, or when you go to develop, if you joint venture or whatever. And you know, I'm okay with where the county is.
Yeah.
Mr. Hoffman?
Yeah, Bonds, I am too. I looked at it a different way, but I came up with a value just over 8 million from a redevelopment approach. You know, with the existing zoning and not assuming that you're going to get the CO, which again, that adds value by completing that process. So just on C3, 7 stories, 10% open space, you got roughly a 220,000 square foot office building.
Yeah.
And very low end estimate at $50 a foot in land. And then, you know, take the worst case scenario and you have to pay the county $100 a square foot because they're difficult to work with or whatever. Then I'm still over 8 million for the residual land. So I'm okay with the county.
Was the parking, Greg, on your analysis, was the parking, C3 requires a whole lot of parking. And you're probably going down 3-4 stories.
Yeah.
Okay, Mr. Metzgen?
As impressed as I am with the 2 analyses of what it might be worth and why, and I that's all speculative. And guess what? We have an accomplished owner of this property who can't figure it out. So, and that's why it's sitting the way it is. And so I would feel uncomfortable without even a site plan proposal, let alone an actual site plan approval, waiting for development to go in that direction. So I see it much simpler in terms of vacancy versus rent. The department said that, sure, the vacancy is low, but so are the rents. Well, relative, and this was brought up already, relative to similar properties in the RB corridor, yeah, the rents are low, but they're low for a reason. They're not investing much in the buildings, and it's short-term leases, and therefore it's unstable for tenants, and they're not going to invest a lot of their time and money if they know that they could be bounced in 6 weeks or 6 months. So I don't see the trade-off of low vacancy and low rents. I think the rents are probably, if anything, a little bit high for these various properties. But I'm willing to accept them, certainly. But I would like to go back to, therefore, the analysis of a 10 and not 4% vacancy, the analysis that the board came up with last year, and therefore lower the operating, increase the operating expenses and lower the NOI, that $60,000 or so, and come up with a lower assessed total of $6,278,500. Just based on, again, bumping up the vacancy, not to the actual amount because it's owner's choice, but at least to a little bit more realistic amount.
I take a different approach to this. You know, I look at this and I don't want to go down the path of this has the potential to be redeveloped and we should be looking at that. I mean, we've already got enough issue when we have a site plan that's actually approved and not being used, and the equalization of that policy. So I don't really want to look at what it could be down the road. I think Ms. Roskin's done the best she could based on the market out there. It is a decision that the owner is making not to offer long-term leases or to, you know, lease it up. I think based on what the future plan is, burden of proof's on the appellant. I certainly don't agree with the appellant's value, you know, and with the county's assessment on this.
Well, the appellant would not sell it for 10% over what their suggested value is.
Okay, Mr. Yates, I'm sorry. Can you just ask to be recognized because I can't see everybody? Okay, Mr. Yates.
The appellant would not sell it for 10% over what they propose the value be.
Correct.
Yeah.
That's true.
Mr. Lawson?
I just wanted to share with Eileen that Jerry Williams was in that office building and he did marrying and not divorcing.
Okay, Mr. Penaranda?
Yeah, I have to, I think, concur with everybody else. You know, I was looking at pretty much the numbers as we did before, not considering like you said, what could be done until, because we don't normally do that until there's actually a site
Right.
plan that is already approved and everything is in place. It's good to see what's the highest and best use that could be applied to the property, but I think in this case, the county is doing, like you said, the best they can. And overall, I think, looking at $7.5 million for a site of this, in this location, I think it's reasonable to assume that the value is there. And based on the numbers, I'm okay with it.
Okay. Anything additional?
No.
All right, then I'm going to move to confirm the county at $7,571,400.
I'll second.
Okay, motion and a second by Mary Hogan. All in favor? Aye.
Aye.
Opposed? Okay, 6-1 with no Mr. Matskin. Okay, the county's confirmed at $7,571,400.
Thank you, board. Thank you, county.
Thank you. Okay, do any board members have any additional business? The county have any additional business? Okay, then we will stand adjourned at 10:27 and re-adjourn tomorrow, Wednesday, August 5th at 9 a.m. Thank you, everybody.
Bye. Have a good day.
Thank you. Goodbye.
Thank you. Have a good day.